I say it often, never invest based on yield alone. Never. I don't care if a stock's paying a 10, 15% dividend yield. If it's not a safe, reliable dividend, then it's likely to be cut, which usually coincides with a drop in the share price. Remember, the dividend yield has an inverse relationship to the stock price. So if a poor performing company sees a big drop in their stock price, that could coincide with a huge jump in the dividend yield. And if it's related to poor results, then that company may no longer be able to afford that dividend. So again, it is very important to never invest based on yield alone. Never invest in a stock solely based on the dividend. And in today's video, we're going to take a look at 3 dividend stocks that I'm going to be avoiding at all costs. Some of them have extremely high dividend yields, and some of them have actually recently cut their dividend as well. But before we jump in, do me a huge favor. Click that like button down below. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before I begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, you can go to fool.com/Mark to see their 10 best stocks to buy right now. All right, let's jump back into today's video, taking a look at 3 dividend stocks that I'm avoiding at all costs. Beginning with dividend stock to avoid number 1, which is Walgreens Boots Alliance, stock ticker WBA. For those of you unaware, Walgreens is a drugstore retailer and pharmacy company. Walgreens currently has a market cap of $20 billion with a dividend yield now of 4.3%, by far the lowest on our list today. But part of that is due to the fact that the company just sliced the dividend in half. So this is a yield that used to be above 8%, still the lowest on our list at even that rate. Why did the company have to cut their dividend by nearly 50%? Well, results have been declining year in and year out, and the stock price shows. Over the past 12 months, shares of WBA have fallen nearly 40%. Over the past 5 years, the stock is down a staggering 68%. And over the past decade, the stock has not fared much better, down more than 60%. Just a few months back, CEO Roussin Brewer, now former CEO of Walgreens, decided to leave her post. She wasn't fired. She didn't retire. She saw the writing on the wall of a company that is in decline mode. Roz Brewer was on the job for less than 3 years and was a top executive before that over at Starbucks before taking over the reins here at Walgreens, but has since not been able to turn it around. Turning our attention back to the dividend, the former 8+% dividend yield was the highest level the company has ever seen. The writing was on the wall when you look back at the cash flow statement and see the company generating free cash flow of $2.50 per share in 2022 and just 16 cents per share in 2023. So with just 16 cents per share of free cash flow, yet the company paid a dividend of $1.92 that year, that means the company was utilizing huge amounts of debt just to pay the dividend, which is something that I never want to see and is usually not sustainable. In 2022, the company used nearly 80% of their free cash flow to pay out their dividend. Free cash flow is an important metric when analyzing a company, and a valuation metric that we focus on for those that go through my 6-week Investing Accelerator course, where you get to work with me one-on-one, understand your strategy and action plan, and determine how to read financial statements and ultimately how to value an individual stock. If you want more information on taking this course with me, check out the link down in the description below. Dividend stock to avoid number 2 is Medical Properties Trust, stock ticker MPW. This should come as no surprise, especially for those of you that tune in for my Dividend Power Hour, my weekly live show, because I get questions on a regular basis about MPW, largely because they have a very high dividend yield. But I usually have the same answer on a weekly basis. Buyer beware. MPW is a REIT that I owned back in the day, as they own properties that are a necessity. Hospitals. Hospitals are likely to be around for the rest of my lifetime. Although even though you have great assets and assets that are in need, if you don't have great operators and a great management team, it doesn't matter. You can still run that business into the ground. MPW is now considered a penny stock, trading near $3 per share. This is a stock I got out of above $20 just roughly 2 years ago, and now it's at $3, quite the fall from grace. MPW is a real estate investment trust with a current market cap of roughly $2 billion. And wait until you see these figures when it comes to stock performance. Over the past 12 months, the stock is down 75%. Over the past 5 years, they're down more than 80%. And over the past decade, had you invested in MPW for the last 10 years, you would be down nearly 75%. Right now, shares of MPW yield a dividend of more than 18%. 18% sounds intriguing, but not if your invested capital is losing value on what seems like a daily basis. Management, in my eyes, is what has been the demise of this company. First off, they were overexposed to one individual tenant, a tenant that hasn't really been that financially stable. And now that tenant is behind by $50 million in rent. So what did that tenant have to go do? They had to go get a loan. Who do you think they got that loan from? Their landlord, Medical Properties Trust, just gave them a $60 million loan. In addition to that, the management team has insanely high pay packages, some that are more than that of CEO Tim Cook over at Apple. And the use of funds to buy company assets haven't been that great, as they've bought cars, they have bought jets. Yes, that was plural, not one, not two, but 3 private jets management felt the need to have. All in all, it seems like the company management has really used Medical Properties Trust as its own little piggy bank, funded by shareholders. And this is a company that I believe has no reason to ever be in my portfolio again. And it's one that I'm avoiding at all costs. Dividend stock to avoid number 3 is AGNC Investment Corp. Stock ticker AGNC. AGNC is one I get asked about a lot, largely due to its high dividend yield. And after all, the company has been paying a dividend regularly since 2008. It started by paying a quarterly dividend, and now they pay a monthly dividend. AGNC has a market cap of $6 billion, but that is just a fraction of what it used to be. The company is known as a mortgage REIT, which means they acquire mortgage assets rather than actual properties like equity REITs. In terms of the dividend, AGNC has a high yield of 15%, which is where the interest comes into play for investors. So the dividend is still getting paid, which is good for those investors looking for that income. However, when you look at the chart here in a second, you're going to see that this is a dividend that, although it's getting paid, it's a dividend in constant decline. Here's a look at that chart where you can see year in and year out, even though the first half of the chart is quarterly dividend payments and the second half is more focused on monthly dividend payments, but still the trend is moving lower and lower and declining over the years. However, that's not the only thing that has been declining. Looking here at this chart, you can see that over the past 12 months, shares of AGNC are down 20%. Over the past 5 years, the stock is down nearly 50%. And over the last decade, down more than 55%. Investing, whether you are a dividend investor or not, all comes down to total return. It's great that if you get a 9% stable dividend yield, but if your overall capital continues to decline 15, 20, 25+% per year, then your total return is actually declining year in and year out. So when it comes to AGNC, the company, as I mentioned, they're a mortgage REIT. They invest in mortgages, primarily 30-year mortgages, which happen to bring a lot of volatility along with them. Now, do I believe this company is in trouble like I do with MPW? No, I think this is a much different situation. However, it's still one that even though it's a high dividend, you still see that dividend trending lower and the stock price trending lower with it as well. Not a spot I want to invest my money right now or anytime moving forward. So with that being said, we just looked at 3 dividend stocks that I personally am looking to avoid at all costs. In the comments section below, I would love to know, do you own any of these 3? Are you taking a flyer on any of these 3? And if you are, let me know why. I'm always curious to hear others' opinions on different stocks. And if you enjoyed the video, make sure you hit that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.